Hello everyone, Professor Christensen here. Today we're going to talk about non-cash acquisitions, so buying assets like property, plant, and equipment when no cash is exchanged, or maybe a small amount of cash is exchanged. So the general rule that you see up on your screen, this is the most important thing to remember. Assets that are acquired without any cash are valued at either the fair value of the assets given up, so whatever you paid, or the assets you received, whichever is more clearly evident. So put a little star on that. That's the thing that you want to come back to when you're not sure at how much you should be recording an asset. Okay, so let's take a look at a couple of examples. Here's the first one. A machine is acquired for $15,000 and the buyer signs a note requiring the payment of the $15,000 sometime in the future plus interest at a realistic interest rate. Okay, so this is a typical transaction where the company signs a note and they're going to pay off the note in the future with interest. And since the interest is at a realistic interest rate, all we have to do is record the machine at the amount of the note. Okay, so we're going to debit equipment. In this case, we're debiting machine, and we're going to credit notes payable for $15,000. Okay, simple entry because we have a realistic interest rate. Okay, so now let's look at another example where we have a non-interest bearing note. So here, the company is buying a furnace and they're signing a non-interest bearing note requiring $50,000 to be paid December 31st, 2022. So what they're saying is there is no interest rate printed on the note. What the note says is, in 2 years, you have to pay me back $50,000. And remember that non-interest bearing note simply means there's no interest printed on the note. But of course, one company is not going to lend another company money without interest. So what we do is we call it imputing interest, or we're going to see how much interest is actually built into this note. All right. And we know that in other circumstances, this company would have to pay 10% interest if they borrowed money. All right. So the actual value of the machine that you're getting, this furnace, is going to be what? I hope that you're thinking it's got to be the present value of the note. What is that note worth today? We can't record it at $50,000 because we're not getting the $50,000 for 2 years. Okay? So we're going to find the present value of the $50,000, and that is the value of the furnace. All right, so we do our little present value calculations however you want on Excel in your calculator or using tables, and you come out with $41,323. What we found was the present value of $1, our N is 2 because it's 2 years from January of 2021 to December of 2022, and our interest rate is 10%. So the value of the note is $41,323. So since the value of the note is clearly evident, more clearly evident than the value of the furnace, we're going to use that in valuing our furnace. So that means we're going to be debiting furnace for $41,323. We're going to credit the note payable at its face value of $50,000. And then the difference between the value of the furnace and the note is called discount on note payable. Remember, this is a contra liability account, and the discount represents the future interest. Okay? So in the future, this company is going to be crediting the discount or amortizing the discount into interest. We're going to credit the discount, and they're going to be debiting interest expense. And by the end of the note, this $86.77 will be gone, and they'll pay off the note at $50,000. Okay? All right, let's take a look at one more example to give you a chance to practice. Let's take a look at this. Okay, so on January 1st, 2021, they buy a used tractor. they paid $5,000 down and signed a non-interest bearing note requiring $25,000 to be paid on December 31st, 2023. The fair value of the tractor is not determinable. We know that the interest rate of 10% is the appropriate interest rate here. Fiscal year end is December 31st. Okay, so they want us to record the journal entry to record the acquisition of the tractor. Now I'm going to pause the video for a minute. I want you to try to put this together. If you're not sure what to do, put in any debits or credits that you know, and then we'll build it up together in a minute. Okay, so pause the video, see what you can do with this, and then come back when you're ready. Okay, we're back. Hopefully you have some pieces of this journal entry. So let's see, what do we know here? I think the thing to do with a journal entry like this is just put in any debit or credit that you know of. So start your credits at the bottom, debits at the top. So we know for sure that they paid $5,000 down. So let's go down here and we're going to credit cash. Oops. No, let's put our A over here. We're going to credit cash for $5,000 because they paid $5,000. Okay? All right, what else do we know? They signed a non-interest bearing note. We know that we're going to put the note in at its face value. So we're going to credit note payable for $25,000. Okay, so now the fair value of the tractor is not determinable. So we're going to have to find out how much did we pay for this tractor. I'm going to debit tractor, or you can just debit equipment. That's fine. So we know that we paid for this tractor. We paid $5,000, right? Plus, we paid the present value of that $25,000 note, right? We paid whatever that $25,000 note is worth today. So we're going to find present value of the note, and that is going to be equal to the $25,000, right, times the present value factor of $1. Our N is equal to 3 for 3 periods, 3 years, and our interest rate is 10%. So your factor is going to be 0.75131. And that is going to give you a present value for this of $18,783. That's the present value of the note. All right, so we paid for the tractor $5,000 cash. We paid $18,783 in the present value of the note, and that gives us $23,783. Now the discount on the note is equal to the difference between the note, right, and the present value of the note. So 25,000 minus the 18,783, and that's going to give you 6,217. So the discount on the note payable is 6,217, and that's also debited. Remember, the discount represents future interest. So when you're all done, go back, add up your debits and credits, and make sure they're both equal. In this case, they're both equal to $30,000, and you're all set. Okay, so that's the end of acquiring assets without any cash or with a small amount of cash. I hope you find that helpful in your studies.